Welcome to Chit Chat Stocks. Before we get into this episode, we want to talk about our friends at Public. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a bond account at public.com. That's a pretty big deal because when rates drop, so can the interest you earn on your investment. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments, but you might want to act fast because your yield is not locked in until you invest. The good news, it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome in. This is another edition of the Chit Chat Stocks podcast. We actually have our special annual review, 2024 annual review, 2025 predictions episode. I believe this one, given how the calendar works out and our weekly release schedule, is coming out on New Year's Day. So welcome to the new year, everyone. We are recording this, and I hope our takes on this episode don't age so poorly that they are wrong in 2 weeks, but we are recording this on December 19th. So if anything happens between now and then that we aren't talking about, well, we can't time travel. So we're going to be talking about our best performing stocks of 2024, also our worst performing stocks, kind of go through our big winners and losers in our personal portfolios. We're going to talk through our 2024 predictions, what we got right, what we got wrong. Spoiler alert. A lot of stuff when we were betting against the Magnificent Seven, a lot of stuff did go wrong. We're going to talk our 2025 hot takes, some of the perpetual bets we have out there, the Uber versus Airbnb for longtime listeners. You know, we have that internal competition going on here, Berkshire versus FanMag, and we're going to review our favorite podcast episodes from Chit Chat Stocks that we think people should go back and listen to as we get into the 2025 year and keep this thing going. So Ryan, welcome into the show. Anything for the listeners before we get started on this first segment here?
Well, all our takes, spoiler alert, all our takes were wrong last year. So if you're looking,
I got the closest though. I got one of mine got somewhat close.
If you're looking for a contraindicator, if you need something to bet against, stick around because we've got some predictions for 2025 that might just all be wrong again. So,
it really does show how hard it is to invest on a quarterly basis or trade like that. It's just a game that is so hard to play, and we're pretty bad at it. But it's fun to make predictions without your money behind it, anyways.
Yeah, this actually brings me back to when we did the show 2020. My prediction was bold. That's the whole point, is bold predictions. And it was that we would not see a 25% broad market drawdown for the entire decade. And that lasted 3 months. And the indices dropped by 30%. I thought the Fed was
at the
end
of 2021. You said that.
No. Going into like when COVID hit, the broad market did collapse.
Oh, yeah. That was a long time ago. To be fair, you were like 20 years old at the time. So, you can say.
That's true. That is true. Okay, let's, I guess we want to kick things off. We're going to be talking through our best performing and worst performing stocks of the year. And not only just naming them, but kind of what went right and whether or not it's something we can replicate with some new stocks. So I guess 2024, Brett, what was your best performing stock?
Yeah, let's get into mine first. It is Coupang. Wrote it up as a stock I was adding to at $14.25 in January of 2024. Stock's at $22.56 today, or it was at the close yesterday. So a 58% gain from there, about a 58% gain in 2024. If I look at what I said in my personal journal from January 31st of this year, I essentially said it's a high quality business with an expanding moat led by one of the best business leaders of our generation, or one of the best young business leaders of our generation in Bomsuk Kim. I said their Prime like Rocket Wow subscription service locks in customers and provides them with incredible value proposition, free shipping, discounts on grocery, fresh grocery delivery, discounts on Coupon Eats, access to their video streaming service, and I didn't really have any short-term catalysts. I guess I talked about the successful Taiwan expansion and the fact that I was very confident that their international revenue could just grow at a very quick pace for a long time. We're starting to see that. So maybe that's part of the deal here. But I really think, given where it was at the time, a $21 billion enterprise value, I trusted the unit economics. I trusted looking at Coupang versus, say, Amazon's estimates of how their e-commerce operation can be profitable in the United States in a richer market. And I thought that if Coupang can get anywhere close to that, then the stock is incredibly cheap. And so far, it seems to be working out.
Yeah, that was one of my best performers as well. And of the ones that have performed well for me, this is maybe the one that had the least change, I guess, in the thesis between 2024 and 2025. Like, the reasons I was optimistic about Coupang a year ago are the same reasons I'm optimistic about it today. There wasn't that much change in the business other than them acquiring what's it called? The luxury e-commerce.
On the cheap.
Farfetch.
Yeah. And that's
but
nice that was a distressed, essentially, play and kind of no downside. It's only a quarter's worth of cash flow. And if they can get it right, could be a big upside, especially with how dominant luxury and fashion is in the South Korean market. What's nice about Coupang is that it is just a great thing about one where you are right about a moat expanding, is that you have no worries about, oh, should I sell this now? It's so nice just having something you're extremely comfortable with just sitting on in your portfolio. You have no worries about it. Each quarter they do fine. The moat's expanding, and versus our cost basis, there's nothing to worry about as of now. That could be a big jinx for 2025. Who knows? Anything can happen, but it's not something that I go, oh, it's up 50%. I should really sell. It's the good thing about not being a deep value play.
Yeah, the moat expansion, I think generally speaking, moat expansions happen just through gradual execution. So it's not the kind of thing where you constantly feel like you have to make a decision. It's just easy to hold, and that was fortunately a good year for us with that one. What was I guess we have the same worst performing one, so why don't I go to my best?
Yep.
This actually surprised me because, so I went to my Schwab account, which is where I still hold most of my stocks. And I did not know what my best performing stock was. So I went, checked, and I thought I had sold this company, but apparently my order did not get filled. And I never went back and checked. Nerdy, we were doing our small cap of the week segment. We do that every week on our power hours, or at least we've been doing it this year. And one of the companies was this online tutoring marketplace. And it really wasn't a very good business. Still isn't, in my opinion, a very good business. It's kind of on the cusp of profitability and growth is stagnating, but it was trading really, really cheap. I think it was basically a defunct SPAC, and the CEO has acquired, I believe it's like north of 20% of the overall company, like the whole company, in the open market in a matter of a few months. So I did not sell it, and I guess it's up 70% in a few months. So that, on a percentage basis, that is my best performer. And it for no business performance reasons, that is my best performing stock, which just goes to show in the short term, like Brett said, very unpredictable what can happen.
But you kind of read the corporate dark arts a little bit there with a small cap, taking a small position there. It's not something you made. Don't make something like that your entire portfolio, but it was a idiosyncratic situation where you had an insane amount of purchases in the open market. Have you sold it now? Did you decide to sell? Did you officially check if the order got filled?
No, I haven't sold it. It's not going to get filled because I did like a limit order sale. I can't even remember what I did. It must have been something. I must have done it poorly. Like I got a
Or you
weakness
did a
in
day
internal
only limit
controls.
order or something like that?
Yeah, my what do they say? Weakness in internal controls. My personal weakness in internal controls.
Yeah, got to clean that
Um,
up.
yeah. So nah, I think I'm just gonna let it sit. The CEO continues to just buy the company. It seems like he's somehow gonna take this public company private all on his own. But let's talk worst stock performance of the year. I think we both got the same one here. You want to talk about it?
Yeah, it is Harbor Diversified. Ticker is HRBR. And don't worry, everyone, it's not trading right now, so there's no way. I think you can actually sell it if you already own it, but you can't buy it at the time being, which is it's in a weird situation. The stock is down 57% year to date. I think this is a lesson in sizing risky positions accordingly. That's the note I made. Now, Harbor Diversified is a microcap company that trades at about, I think, under their net cash on the balance sheet. Definitely right now, but even before this trading halt went through, and they're a regional airliner. They changed contracts from United to American Airlines, and they've had all these things happen because of the pandemic and the pilot shortage and stuff like that. And they're kind of working through that. And they had a dispute with United. They thought they were going to get owed money by them. It went to trial. They didn't get any of the money. They had to restate some of their financial statements because of this. But I think given how small of a company they are, it's going to take them a while. And they didn't file their annual report until I think it was last month. So they're behind on their filings. And given that, they've become delinquent, not tradable, NT. It's kind of next to the position in my brokerage account. And given the fact that you can't, Schwab, IBKR, Public, you can't trade it there anymore, or you can't buy shares. You can only sell it. Well, the price has collapsed, and I honestly still like holding it and waiting to see what the outcome is here, but didn't do too well in 2024.
Yeah, I mean, this just goes to small caps, right? It's like I just talked about one small cap that's up a lot, and nothing positive has happened in the business. With Harbor Diversified, I would say it's in a better place business-wise. I think it's in a better place business-wise today than it was a year ago. They've got the new contract with, I think it's American, and it seems to be going well. They're kind of making progress there, and it's probably today a cash flow generative business that is trading for less than the cash on the balance sheet. But with that said, it's down 50% from a cost basis because anything can happen with these illiquid securities, and there's almost two different games. There's the business performance and the stock performance, and with small caps, they can be completely uncorrelated due to really unforeseen factors. This is one of them. And you can't, I mean, you really can't have a worse situation than everyone can sell and pretty much no one can buy. It's really hard to make a stock go up when that is the case. So, yeah, it's the biggest loser on paper. We'll see.
Yeah. We haven't sold yet.
I
haven't realized those losses yet. Yeah. I'm hoping that the company bought back a lot of stock while these people are, forced sellers. And I do think the stock is still cheap. It is one that you literally have a difficult, I can't buy anymore right now. So again, it's a very risky position. It's one that it's a small percentage of the portfolio. Do not make this a large position. And it's one of those with a high risk, high reward. But you got to be, as Ryan mentioned, you got to take there's going to be some hits in microcap and small cap land. There's going to be some big losers. You just got to accept them and know that if that's the strategy and that's the type of stocks you want to own, it's part of the game. Volatility.
Yeah, and this was a lesson totally learned the hard way for me on position sizing. I made this way too big of a position.
You're younger though. You got, money coming into the portfolio. You can think of it that way. It's not like you made it a big position when you got a 7-figure account.
Right. The idea, part of it was that I was just going to buy it in one big bulk, so I didn't have to pay a huge commission on it. And if I then I could just add to everything else over time. But yeah, it was a mistake. I think with these things, the way to go, really, especially high risk small caps, is to make it a small position. And if it does work out, it'll become a big position over time. But
that's true. And we're still going to be bag holders in 2025 unless they get updated on their filings. And we'll see what happens there. We have no idea what the numbers were in 2024. So that's how far behind they are on their filings. But hey, fingers crossed. We'll see. We'll see what happens. I did see, now this is some real bag holder digging. On their careers and hiring page, they did have someone, an accounting position that got filed. And one of the things was your duties were going to be for this new role that they're hiring for is working with SEC filings and filing 10Qs and 10Ks. So I think that's a good sign that they're going to try to file.
It's hopeful.
It is hopeful,
concerning. That kind of makes me think someone left.
That's true. That is true.
But yeah, let's talk our 2024 takes that aged not too well. You want to go through your first one here?
Yeah. So, okay. These were 2024 hot takes. These are ones that we did at the end of 2023, and we said, look, gut feel, we're not making any, say, investments based off of this, but this is what I think is going to happen in 2024. My first one was that the big three tobacco stocks, Altria Group, British American Tobacco, and Philip Morris International, on an equal weighted basis, will outperform the Mag 7 on an equal weighted basis in 2024 on a total return basis. Well, I was wrong. Not because the tobacco stocks did bad. I think overall they probably had pretty solid returns. I should have the numbers there, but I'd say pretty good. No one would be upset with those returns. But hey, look, Mag 7 absolutely crushed it. My idea was that I think you copied in my notes from the time that Mag 7 had an average PE of 50, with only one of them likely under earning today. I guess Nvidia proved that incorrect. But the tobacco stocks were trading pretty cheap. I still like, over the long term, I do like from the beginning of 2024 investing in those big three tobacco companies on an equal weighted basis. I do think they will do well through the market cycles. But in 1 year, Mag 7, if you're betting against Mag 7 in 2024, there was really nothing that you could do. And that was two of my takes.
Yeah, and Nvidia is a prime example of sometimes Mr. Market is really dumb, or Mr. Market, people say, oh, Mr. Market's having a bad mood or whatever, as a way to justify like the stock price coming down. Sometimes Mr. Market and Wall Street can see a lot further than me and have better data and have a better eye on the ball. Because if we look back at Nvidia this time last year, and I think the stock was up an insane amount in 2023, I would have said there's absolutely no way it has a great year again in 2024, at least like the year it has. And that was just better foresight, I think, from bigger investors. So, yeah, I think that, not to the detriment of the tobacco stocks, I think they did perform well, but ultimately just goes to show how impressive and durable these Magnificent Seven businesses are. Because I think we've had bets against the Magnificent Seven for like, other than 2022, it seems like every other year.
Yeah. Hey, look, 2022 was the best year to be optimistic about them. I will say we were, but they've been just each and every year throughout the pandemic, they've just dominated. The one thing I'm starting to understand as an investor, and this is something that you kind of internalize the more experience you have, it's very difficult to, and maybe it's just what I think I'm good at and bad at. Like, I'm very bad at predicting the momentum trades and whether something's going to continue. And if the momentum type stuff, or the one where it's betting, okay, Nvidia's revenue growth is going to keep accelerating and growing and growing and growing. If that doesn't slow down, I'm not really good at predicting when it's going to stop or if it's going to continue. And when I try to fade that with some of these hot takes, which it's not like I'm shorting them or anything, usually doesn't work. But what can be something I think I am better at is like a 3 to 5 year time horizon. And I think that Mr. Market is not focused on that.
Yeah, if you look at the FANG companies, I think for pretty much every one of them, 5 years ago, we would have said these will be better businesses, or these will be bigger businesses, revenue and profit-wise in 5 years. We would have been directionally correct. But at any time, for the most part, we probably could have said it feels overvalued simultaneously. So it's, yeah, short term, it's hard. It's just, it is above my pay grade and really not a game I want to play. Let's hop to my first hot take, which is kind of along the same vein. In 2024, I predicted that U.S. Treasuries would outperform the Magnificent Seven. I was wildly wrong, unfortunately. You probably got a decent return with Treasuries because
Yeah, what was it? 1 year Treasury, and it was yielding what at the time?
It was yielding 4.8%.
All right, let's check her out. Let's see if you got any. Well, I guess you really just what you got in the return. It's at 4.27%. So I guess, well, it was 1 year. So I guess you got the principal back anyway. So the appreciation price doesn't matter too much. But hey, maybe if it was a longer term one, you got a little of that gain too.
Yeah. All right. How about your second hot take here? Would you say it was right or wrong?
I think it's wrong. And the prediction was the cable TV bundle model will finally collapse. And my idea was that the model will break for the Disneys, the Foxes, the Paramounts, the Warner Brothers Discoveries of the world. And my prediction was that Disney was about to start their true D2C application for sports, leaving even less of an incentive for sports fans. I guess that's gotten delayed. I don't follow the company that well, but they seem to always say, well, our D2C app is coming soon, and then it never arrives. And the one thing I had was the NBA about to renegotiate its TV rights deal, which I think was that part ended up being correct because one of the chunks went to Amazon. And the regional sports networks were dead. And I thought we are going to get picked up by some streamers or the rights for that were. Turns out people move slow in this industry. And we still saw a decline, I think, traditional pay TV households. But as long as the bundle still remains as an option for customers, I think that prediction proves wrong. I mean, what's weird, what fascinates me about this one, though, just to follow it, is that what is the end game of these? Is it eventually over, or is the bundle going to remain and just translate to the YouTube TVs of the world?
Yeah, I think that is, like, if you are the content producers, you license them to the YouTube TVs, which are just literally, seemingly, the CTV bundle replicated all over again. And in fact, you're not saving that much money.
Well, you're saving money from the cable bundle, but it is frustrating when the only reason to buy the virtual cable bundle is sports rights, and you pay 80 something bucks a month for some sports thing that 95% of the channels you don't care about. It is frustrating.
Yeah, I don't know how this shakes out for the losers, but my prediction would be that this is good for the sports leagues. Like, potential bidding wars between anyone that wants your content in the streaming world. I think that's probably a good thing. And you can even chop it up a little bit between, you can give some to YouTube, some to Amazon, some to your NBCs of the world, Peacock.
Disney.
Probably revenue accretive.
Yeah, and you're going from, okay, the only reason people are buying this is you, and then you have this fee associated with it that is a small percentage of the channels that are offered, to, okay, hopefully people are just buying like your sports bundle or sports content stuff, and the fee you can charge is higher because you actually can charge for what the value people are going at. Because it's crazy that people are willing to pay 80, 90, 100 bucks a month, and truly the only reason that they get it is the sports. But the sports rights holders in the leagues are still getting or the channels, excuse me, like the ESPNs, the Foxes, they're only getting, I don't know what it is, $4, $5, $6.
Yeah.
It's interesting. What's your second one?
I predicted that the consumer discretionary sector would have negative returns for the year. Now, this ultimately was way wrong, but the best tracking ETF for the consumer discretionary sector is last year at this time, Amazon was 22% of it. So that's a little unfair. It like not.
Yeah, because
I
it's
don't
the
know if it would
cloud
have
and
been
the
right.
AI. Yeah.
Yeah, I don't know if it would have been totally right, but like the other big companies that make that up are Starbucks, rough year. McDonald's, a little bit of multiple compression, I believe, also had a rough year. Comp sales started to decline. Nike, tough year. A lot of the big restaurants saw significant sales decline. I think directionally, and in terms of the business performance, you look at the consumer discretionary category, especially the ones that are not value retailers, and they had a really tough time in 2024. But ultimately, it did not have negative returns in all.
At the middle of this year, and in the summer, in late summer, this looked like a really good bet, excluding that ETF that includes a tech company. Starbucks, McDonald's, Nike, all down a lot. They've recovered a bit throughout the fall and the early winter here, but hey, I think that's partially right. I give you maybe your money back if it was a
I'll
betting
take
market. Yeah,
I'll take it. All right, how about your third one here?
so this one was financials will be the best performing sector of 2024. My reasoning at the time was that generally stable interest rates mean they're likely under earning, and I guess that ended up being correct. Interest rates have declined a little bit, so they've been fairly stable in 2024. Second idea was that the consumer is fine, even though sentiment around the consumer is low. That ended up being correct, and that they're all trading at a discounted PE because of that. You know, people are just really scared about these companies. Well, what we got here? Financial services up 27% year to date, but lost out to consumer cyclical, technology, communication services, and I think that's it. What's crazy is that when we did that show, that was when we had stopped the investment fund and had it was like a strangely long period before we got our money back from just all the compliance and regulation stuff. And I was getting ready for my personal portfolio. Frustratingly, at the time, I was like, okay, American Express and Ally, I think are pretty attractive. This is in late 2023. And then before I got my money back, they jumped a ton. So this, I think, prediction looked very right at the start of this year. But now it's kind of evened out as, you know, a lot of these tech and communications and consumer stocks have caught up.
Yeah, the timing on that was unfortunate. I would give you your money back for this one as well. I mean, it technically was not the best performing sector, but it was up there. One of the top 4, it looks like. So good performance. Ultimately,
yeah, we don't want to be the people that say, well, it's just, you know, if we exclude the bubble, it's like, okay, well, you know, you can't do that. It's, you know, the meme when there's one guy on the left up 1,000%. And it's like, oh, I'm doing so well. And then the angry guy at the right, just wait. You know, the crash is coming. It's like, all right, well, I'll still be beating you.
Yeah, that's true. All right, my third one here could not have been more wrong, I think. Match Group gets acquired or is up 50% by year end. I'm actually not exactly sure what the price was when I made this prediction, but it's not up 50% in the last year.
No, I'm seeing at the start of the year, Match Group was about $36.50, and today we're at $31.60. When was it?
Wrong.
Early? Was it spring? I think we both decided to turn away from Match Group, break up with the dating app conglomerate, and not invest in it anymore.
Yeah, I don't know if it was just chronic frustration with like poor communication from management that led to it, but eventually I was excited to no longer be a shareholder. I just kept clinging to it's cheap. And my theory here was that Bernard Kim had done a good job turning around Zynga and ultimately getting it acquired by Take-Two Interactive. So I thought Bernard Kim, who has come in as the CEO of Match Group, could maybe do the same thing. And it could be, if it's run well, it could certainly be a nice little cash cow for anyone that wants to acquire it. But I don't know who the acquirer would have been. And it seems like if they don't want these assets now, I'm not sure who would want these assets in the future. I don't know who would.
But I'm sure private equity wants would take them out for a pretty cheap price here, but I'm sure that the company is saying it's too cheap of a price. Yeah, if they get offered $40 a share, they're probably walking away now. But maybe in a couple of years, if it keeps stagnating, maybe this year if it keeps stagnating, they'll go for a take under. This is one that I think the price action over a multi-year period just makes us turn away. So if you're coming at it with fresh eyes and you're optimistic, maybe that fatigue from us and the other people that have followed this story for a long time could present an opportunity for you here. Because if Tinder's user growth even just stabilizes, this stock is going to do well. But I'm not confident that it will. I have no idea if it will.
I think Tinder's going to struggle, would be my prediction. It's just, they tarnish the brand so much that it's going to be hard to come back from. But anyway, that ultimately was wrong. And yeah, if your thesis is a private equity buyout, that's probably not a good thing. They're not paying a major premium to get you. So
yeah, that should be the cherry on top. That should be the cherry on top of any investment thesis.
This episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they collect and summarize the best stock pitches and bring them to you in a single place. If you're a regular listener, you know that we use Yellow Brick every single week here on the podcast to discover new investments or just find reports on companies we've already heard of. Try it for yourself. Simply go to joinyellowbrick.com/chitchat and search a company or ticker you are interested in. You are bound to find a great report on just about any company. That's joinyellowbrick.com/chitchat.
All right, folks. If you're a regular listener to Chit Chat Stocks, then you know that we use finchat.io daily. FinChat is the complete stock research platform for fundamental investors. They have robust financial data on more than 100,000 stocks globally, including company-specific segment and KPI data. Want to see Google's Cloud's quarterly revenue growth? FinChat's got it. Like to track PayPal's take rate? They've got that too. And they recently added sell-side conferences and insider transactions to the platform. Best part is it's completely free to sign up. However, if you want to get unlimited data, you can use our link finchat.io/chitchat to get 15% off any paid plans. The link will be in the show notes. All right, next segment. 5 stock market takes, 5 stock market predictions for 2025. As you just listened to, I guess we weren't technically right on any of those, but some of those were direct, I think, from the not being confident on consumer discretionary, tobacco, and financials looking attractive. I would say that, some of that looked pretty smart. So don't fade all of this, but I have a hunch here on one of yours, Ryan, and I'll let you go first because you have 3 and I have 2. One of these, I think you're trying to jinx yourself for your portfolio.
That would be correct. Yes.
Yeah. All right. What is your first one?
So I wanted to make these a little more stock specific. The first one is not a single stock specific, but I have been wrong. I've been very wrong betting against Mag 7. So I'm done doubting them. And despite the S&P 500 trading at one of its most expensive multiples in years, I think the Mag 7 equal weighted, which actually what's the new acronym? We got Broadcom in there as well.
I think it's Batman.
Batman. Okay.
I think because you have Broadcom, then you can put all the A's in somewhere. Tesla, Meta, Nvidia, and then the A's probably have 2 A's. One of them has 2 A's.
It's like Batman or whatever.
Yeah.
All right. Okay. So my first one is that the Mag 7 equal weighted will be up by more than 12% by this time next year. So
that's underperformance compared to history. I think if you queued some of these individual investors, they would say, "What do you mean? It's going to be up 50% again?"
Yeah, I think that's quite unlikely, but the 12%, that is a good year, especially
great year.
Comping a great year. So I don't know if it's a hot take or not, but yeah, that is my prediction. And you know what? The other thing is, like, since we started investing, my thought has always been law of large numbers. How are they going to do it? How are they going to fulfill this valuation for a lot of these companies? These great businesses tend to surprise to the upside.
Yeah.
They are great talent attractors. They produce new businesses that are revenue accretive. I mean, why is Google jumping right now? Waymo. That was not a part of anyone's thesis 10 years ago. They continue to reinvent themselves. So I will try to back up my take. I am kind of hoping for once the performance is bad so that I can maybe outperform the market. But so it's a little bit of a reverse jinx, but there's something to be said for the absolute sheer quality of these companies.
Yep. Or if you're Apple, that multiple can expand from 20 to 42. That's not bad for shareholders either. All right, my first one. Amazon finishes 2025 with the largest market cap in the world. Now, this is excluding something like Saudi Aramco, talking about non-state backed stuff. I'm stealing this one from our predictions and hot takes show from last year with Investing Unscripted, where I said the exact same thing. You know, those are supposed to be kind of bold predictions, very hot takes, something that is unlikely to happen. I think after this year's run-up, where it's done quite well, it's much more likely that they finish the end of 2025 with the largest market cap in the world. You have a earnings inflection, and the key is going to be how high profit margins can rise. We're already hitting about 10% on a consolidated basis. If we can get that to 15% and seeing a path to 20%, which I think is not being priced into the stock right now, we could get there. And the only thing holding them back might be their propensity to reinvest into science projects.
Yeah. And the bigger they get, the higher that propensity to reinvest in science projects.
We got more money to spend on Kuiper. Good. Yeah. Great.
Okay, I like that one. I think it is doable. It's probably about a 30% increase and a 30% decrease in Apple's stock to make that doable.
Yeah,
right?
Yeah. Amazon right now is at a $2.35 trillion market cap. Let me confirm Apple for you.
I think it's like 3.7.
3.78.
Okay.
Wow.
All right.
PE of 41.
My number 2, and this might ruffle some feathers for anyone that loves this company. And
Palantirans.
Yes. Spoiler alert. I think Palantir will get cut in half. I'm not even sure if that's really a hot take. At this point, owning the stock might be the bold prediction because it's nothing. The economics look pretty good. Like it's a growing business. Seems like a good sales organization, good software. I guess I don't really use it that much, or never have used it or looked at it.
Well, you're not a general in the U.S. military, so
true. But and they are profitable too. The multiple is simply ludicrous. They are trading at a forward price to sales of 49 times. That's insane.
Yeah. Higher market cap than Lockheed.
That is really expensive.
Do you know what the market cap is?
Let me guess. 200 billion.
169 billion. I hear it's 100x from here. I've been told by reliable sources that it's 100x.
This is one of those stocks that has developed sort of a cult-like following, and I think probably the mystery around the business helps foster that cult-like following, because a lot of people don't really know what they do, myself included, and probably a lot of the investors, because they try to keep it somewhat discreet, and they use a lot of very sexy terms like data fusion platforms,
AI bootcamp,
that it keeps people guessing. So yeah, that is my prediction. 50% drawdown in Palantir. We'll see if it happens. Who knows? Maybe it multiple doubles from here.
Send your hate mail to Ryan. I love a long-term, long Lockheed Martin, short Palantir pair trade.
That's interesting. Okay.
Just because of the market cap thing. It's not like I'm uber bullish on Lockheed, but
yeah, I was gonna say I hate relative market cap comparisons, but yeah, it's sometimes
they're technically
fun.
In the same industry.
Yeah, I mean, you could see a world in which it makes sense in the future if growth persists like this for Palantir for 15 years. But
Well, I've done some Motley Fool articles. You need about 30% revenue growth for 10 straight years and 30% GAAP operating margins. And then the current valuation, the current market cap, assuming no share dilution, is somewhat reasonable. So just have that.
you know what I should have done for this? Maybe I'll try to do the math quickly while you talk about your second take. But when you think about companies that have compounded revenue at 30% for 20 years or even 10 years,
Yeah, just
if
10.
you paid, I'll use Salesforce. Maybe I can do it. Where I'll see what happens if I bought them at 65 times sales.
If you can do this immediately, that's impressive. We'll see. We'll put you on the clock.
What the earnings would have been. I'm going to need our friends FinChat here, so feel free to take your time on the second take.
Yeah, I guess this is, hey, that's a good timing to talk about our friends at FinChat. Use our link finchat.io/chitchat, and you can do this complicated math in a quick manner. Save you time, save you money, give you more analysis, all the sort of stuff that you can use to track your investments, do research, investment transcripts, charting, everything else. finchat.io/chitchat. Get a 15% discount on any paid plan. All right, my second prediction, and this is a fun one. I think Nintendo's United States ADR will double to $30 a share. So I think at some point in 2025, Nintendo's ADR will be over $30 a share. For anyone that doesn't know, ADR is just it's like a synthetic stock that just tracks versus they're listed in Japan, but it just allows US investors to do that. Ryan, you come up with the math.
I think I got it. Yeah.
Wow,
So, okay.
quick. FinChat's good. FinChat is good.
If you go to FinChat, look up Salesforce's revenue over the last 20 years. Let's take it from 2012. If you paid 60 times sales in 2012, you would have been buying Salesforce at a market cap of $183 billion. Today,
we're assuming shares outstanding don't change, just to keep it simple.
Sure.
Yeah.
Today they have a market cap of $322 billion. So revenue would have 10x'd, more than 10x'd, and you would have gotten less than a double on your stock returns, assuming share count stays the same. It's not growth. You're paying for a lot of growth is the moral of the story there.
Yeah, no. Palantir's 100x, Ryan. You just don't get it. Okay. Nintendo, say it's going to hit $30 a share, and the US ADR just, the yen can get wacky. So we're just going to stick with the US one. They're launching the Switch 2. I think they're going to have record hardware sales, record hardware velocity, where the rate of sales are going to be high just because there's this pent-up demand. This is the longest cycle in between new hardware launches. And I think it's going to get, the sales rate is going to be higher than any period except for COVID. Software sales are going to boom with new Mario Kart coming out in launch with the new cycle. We have the new movies coming out, the theme parks that'll drive demand for these. And the company will finally get the piano off its back. That is the narrative around it being a unstable earner. Earnings are going to grow, multiples going to expand, and to get to the double without any share buybacks or dividends and stuff like that getting included, or the net cash and stuff growing, the enterprise value has to go from about $57 billion to, what would that be, $112.5 billion. So I think it's doable.
I'll probably take the under. I like the thesis, but I'll take the under. A double's big.
All right. This is one that's going to be fun because we can track it.
Yeah,
sure. It's very black and white.
Jot down there that Ryan will take the under. Okay, my third hot take is in the same vein as Brett's first one, except a different company. Google will be the largest company in the world by the end of 2025. This will come predominantly from multiple expansion. We've seen this over the last 2 weeks. People have gone from Google's an AI laggard to Google is the future of AI. The whole quantum computing thing, I could see that getting hyped up. The recent model that they released seems to be getting tons of buzz. Waymo is somehow becoming a part of the thesis despite being such an inconsequential amount of the actual top line. I think with all these exciting initiatives we could see serious multiple expansion. Maybe I should change this to in a year from now, people are giving Sundar Pichai the Jensen Huang effect.
Yeah, maybe.
Where
He's not
everything
as
he says is
charismatic, though.
gospel.
Yeah,
True.
he's just not as charismatic. He was trying to, in that deal book interview, he was trying to talk trash to Microsoft's stuff, but I gotta say, Sundar, you're way richer than me and more successful, but you sounded like a total nerd when he tried to talk trash to Microsoft. He was like, and do they use their own models? And he was kind of looking around, and people were like, what? And he's like, they don't. We do.
Well,
execution on the jokes
give it
need to be a
time.
bit better, but you
He'll
know
have
what's
a press
interesting
team.
here?
He'll have a press team that saves him.
Yeah, that's true. You know what's interesting here? Market caps of Google and Amazon are very similar. And I thought maybe we could do a competition here where if either of us is correct, which means the other person isn't, but also neither of us could be correct. If either of us is correct on this one, I think the other person buys a share for that person.
Sure. So what? We just Venmo each other the share amount.
Yeah. Company expense.
Okay. Yeah, I guess. Sure.
We gotta make it interesting, right?
I mean, I don't love Google that much. But
yeah, I don't even own Amazon.
I do own Amazon, funny enough. So
yeah,
all right.
It's a bit weird.
Maybe. Well, I'll be happy if Amazon's the biggest company in the world.
We'll figure something out. We'll say figuratively, I guess. yeah, we don't have to do it, but
okay. Those are our 5 hot takes for 2025. So just to recap, the Mag 7, Ryan believes the Magnificent 7 will be up more than 12% this year. He also believes that, I believe, Palantir will get cut in half and that Google will be the largest company by the end of 2025. Brett believes Amazon will be the largest company by the end of 2025, and Nintendo's United States ADR will double. There is an honorable mention here.
Over $30.
Okay. There is an honorable mention here. Do you want to talk about that one?
Yeah, we have 5 here, and just 5 stock market predictions for 2025. That's a catchy title. We had one that didn't make it through, but it's one I want to talk about. It's maybe our honorable mention that almost made my predictions, and that is Apple stock falls 50%.
All right, listeners, we've got a new sponsor here on Chit Chat Stocks. The name is Blue Chippers Club. Blue Chippers Club was recently started by 2 friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this awesome community, everyone gets to share and break down their portfolios with each other, participate in weekly calls, and compete in fun portfolio performance competitions. I really like this idea, and it's why we're promoting it here on the show. In fact, Brett and I are in the community ourselves and enjoy just how much value we get collaborating with other investors. When I first got into investing, a role model of mine recommended that I build a network or community of friends to bounce investing ideas off of, and Blue Chippers does just that. If you're interested in joining, head on over to bluechippersclub.com and hit apply. Right now, it is completely free to join. The link will also be in the description.
Heads up, folks. Interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/Chit Chat Stocks. I've been talking very bearish on Apple all in 2024. Ryan's heard it. The stock keeps going up. So I think I'm going to officially call my shot here with the stock trading at a PE of 41 and saying, can we say it falls 50% from its all-time high? Is that a fair thing to say? Yeah.
I mean, it's basically at all-time highs. So
pretty close. What do you think of this one? Is Buffett right? This would vindicate Buffett, and that would make his trade in Apple even more legendary if he got out at the top.
That is true. It is so hard to be bullish on Apple, just to be totally honest. It's 42 times earnings. This is a business that truly, truly is not growing right now. Like, go look at a revenue chart. Let's pull it up. Let's get our friends at FinChat here. Ryan, do a little share screen action.
I think it's down from trailing 12 month is perhaps down from the peak in 2021.
That would make sense, in my opinion. Okay, Apple total revenues last 12 months.
Yeah, last 12 months.
It has been flat for 2 years. Maybe there's another leg up here.
10 quarters.
But I would be very surprised.
What is the next leg up? The AI super cycle? You know what I saw Tim Cook tweeting about? They renewed Silo for season 3 and 4, which I like that show. It's one of my favorite shows. It's a great show. But you got Amazon, Google, Microsoft, and Meta pouring $50 billion a year into AI initiatives. Apple's got Apple Intelligence, which is not real, a flopped Vision Pro, and what? Apple TV Plus?
Yeah. But here's the part where I think you could be wrong. I think you are underestimating the abilities of big funds to buy this blindly. I'm serious.
Mainly passive.
They've got no sellers.
Yeah, the passive
Except
inflows
for
to
Buffett.
Apple isn't. Yeah, true. The passive flows into Apple are insane. I don't track this stuff. I don't really know how to track it, but I saw someone say earlier this week that, I don't know what the rate was. Maybe it was on an annual basis or a quarterly basis, that the smallest company in the S&P 500 on a market cap basis or float adjusted basis was American Airlines. It's got a market cap of like 10 billion and it gets $100 million in flows a quarter from passive. Think of how much Apple gets.
That is, yeah. It's nice if you're an executive to be included in an S&P 500 company. Gives you a lot of stability without a lot of selling. And it's very nice.
Until 2020. Till 2020 happens. Excuse me. Couldn't finish that sentence.
True. Okay. We had a bet, I believe, 3 years ago.
Must have been, yeah.
Do you want to talk it over here?
Sure. So it's Airbnb versus Uber. If I'm looking at when Airbnb went public, it was 2021. So I'm guessing we made it around then because it must have been at the end of 2020. That's when they went public, right?
I think it was earlier.
Well, look at this market cap chart here on the sheet.
I think it was when it was private.
Oh, we were just saying. Yeah, well, okay. That's fair. It was maybe when Uber went public, and I was saying, so regardless, for a long time now, and it's not like I don't think either of us have ever owned these companies, but from more of a debate and argumentative perspective, Ryan's been more bullish on Uber, I've been more bullish on Airbnb, and we kind of had a bet that, what about the end of 2023 or end of 2022, that Airbnb, I said Airbnb would have a larger market cap. He said Uber would have a larger market cap. For a little bit, Airbnb was winning by a small amount. But this year, at the beginning of this year, Uber really started to moon and kind of expand a lead. But they recently gave up a lot of these gains. And I kind of like it being a perpetual bet. They're two companies tied at the hip almost, founded at the same time with the gig economy model sort of deal. And they're very, I don't know why, but they always seem very related. And I like this perpetual bet. If we look here now, Uber is still winning the market cap about $125 billion. Airbnb down to about, what would you say? Maybe that's 80. Yeah.
Yeah, that's 80.
What do you think? What happens here? What happens to this chart over the next couple of years?
So you're asking me who's larger in 2027?
How about just next year?
Next year, who knows? It's so...
That Waymo narrative.
If Waymo launches in 2 more cities, Uber
that Waymo
could be
narrative,
trading at 15 times earnings. I think Uber remains larger. I do. I like it.
In 2027, Uber remains larger?
I think by 2027, there's a chance Airbnb catches them. But it really depends on the whole... Yeah, no, you know what? No, I'll take Uber. I'll take Uber. Because
Yeah,
I don't
guess
think
I should have.
Waymo's going to make much inroads by 2027.
Yeah, maybe I can pull it up. Let's see what the net earnings are for each, or maybe operating earnings for each of them. You have any guesses? Do you want to pull up Airbnb? I'm pulling up Uber.
Sure. Airbnb, I don't know. Uber, I know, has become more profitable here lately.
Let's see. Last 12 months, Uber's operating income $2.68 billion. But let's look at gross profit. So we can compare those.
Airbnb's 1.6.
Okay. And what's Airbnb's gross profit?
9 billion.
Yep. Uber's is 13.7 billion. So still, they've maintained that lead from bottom line and kind of top line unit economics as well. I could see Airbnb catching them though.
Okay, I think both companies will probably actually have a similar growth rate. Maybe Airbnb grows a little quicker, but I think they're more developed of companies than people give them credit for, despite them being kind of fairly recent concepts, as in less than 15 years old. I think maybe less than 20 years old. I think they're like pretty mature. I don't think they're going to grow 20% plus. They're definitely not going to grow supply 20% plus.
Yeah, true.
So I think you're going to get similar growth rates. The earnings multiples seem fairly comparable.
That's why they're fun. That's why it's a fun competition.
I'll take Uber.
Yeah, I don't know if I'm taking Airbnb. But what I do know is if both of these, if the narratives turn on either of these companies, I could see myself owning them if they get cheap enough. And we've talked about that a lot in the last half of 2024, or the last month or so with Uber here. Here's another perpetual update we have, and it's a prediction I made at the start of 2021. I'm forgetting exactly what I said, but I think it was including the $5 trillion companies at the time and not including Tesla, because I think they hit the $1 trillion in 2021. Either way, I only did the 5 old mega cap companies: Meta Platforms, or Facebook at the time, Amazon, Apple, Alphabet, and Microsoft. So no Tesla, no Nvidia, no Netflix, no Broadcom. And Broadcom was much smaller at the time. I essentially said that Berkshire Hathaway would outperform these big tech companies from January 1st, 2021 through the next 3 or 5 years. And we can update them. And would this be 21? This would be 4 years now. The competition is so close. Berkshire Hathaway, total return since January 1st, 2021, 92.84%. The equal weighted Meta, Amazon, Apple, Alphabet, and Microsoft, 93.5%. So barely beating the Buff Dog.
Seeing the stat blew my mind. I thought FanMag would have crushed them. I had no idea Berkshire returns were this good. That is really impressive at this size.
Do you want to guess the 2 companies that have underperformed Berkshire on a total return basis from January 1st, 2021, and the 3 that have beat it?
Well, I'm going to guess Apple's really close, because I think Apple probably accounted for a lot of the equity returns.
That's true. I guess it's a little bit circular there.
Berkshire underperformed. God, they must
easy,
all
though.
be
It's
in a
easy
similar ballpark.
Really? One really is underperformed. Still positive, but one is really underperformed. You got to think who's the biggest pandemic beneficiary.
I mean, Amazon ultimately benefited, but I don't know who underperformed from this list.
It's tough without looking at
Alphabet.
it.
I would guess Alphabet underperformed.
Okay, that is incorrect. Your first hunch was right. Amazon, 35% returns. Sorry, these fonts are low. Let me load it up. Amazon, 35% returns. Apple, 91% returns. So you're rock on there. Almost exactly Berkshire. And then Microsoft, 103%. Alphabet, 118%. And Meta, top dog, 119.5.
Wow. I did not realize Amazon had such a tough time from pre-COVID.
All right, who
Well,
wins over the
that
next
wasn't
3
pre-COVID
years?
though.
That's what I'm saying. It was the end of
Oh.
2020, so they were the biggest 2020 beneficiary when Amazon just absolutely soared.
Okay, yeah. That makes sense. Who wins over the next 3 years? Give me big tech.
Yeah, probably. Berkshire's done the multiples, I think, up there.
I honestly don't follow it that closely.
Nah, boring.
I'll probably go to the meeting this year, but I don't follow it very closely.
Yeah, it's boring. Who wins over the... Okay. Sorry, go ahead.
Yeah, there's just not that much excitement in... It's just like that I would have loved to own them 30 years ago when things were like the growth rates were still pretty solid. But like there's the law of large numbers. Maybe it doesn't apply to big tech, but it does apply to Berkshire.
It applies to every company eventually.
Yeah, that's true. All right.
Not Palantir, though. Oh.
Last segment here. Favorite episode of 2024. Favorite podcast episode that we did of 2024. What did you enjoy the most?
My criteria here is one that I think people should go back and listen, because I find a lot of insights from this episode, or found a lot of insights from this episode, and I think any listener will as well, especially when it regards to studying a company, researching them, formulating a thesis or not, and deciding whether to buy it. And well, it lines up with my best performing stock of 2024, so maybe I'm seeing it through rose-colored glasses. It is our episode titled, Is Coupang Stock Really the Next Amazon? With Speedwell Research. And it's essentially going through a comprehensive overview of Coupang's business, the stock, valuation, all that good stuff. It was one of our most popular episodes of 2024, so I know people enjoyed it already. But if you haven't listened, go find it in the feed. You can search that title. It'll pop up on whatever podcast player you have. And I think there's still a lot to learn from that episode.
Yeah. All right. I'm
You?
cheating here. I've got two. I instantly have this like inclination to do to say whatever stock performed well that year was like one of my favorite episodes to do. So I did enjoy the Remitly one, but I didn't want to just do stocks that did well. So we started our investor research episodes, and this might be recency bias talking, but I really enjoyed studying David Gardner and actually digging into some of his returns, because a lot of the stuff I just hadn't realized, and kind of trying to adopt some of his philosophy. I think of all the episodes, I think I've said this before, but of all the episodes we did on investors, his is probably the one where I want to try to steal some lessons the most. Druckenmiller, it's a little hard to apply some of the lessons or his philosophy, his approach. Same with some of these others. So I really like that one. And then the last one I'll mention, we did a research episode on Wise. I thought that was informative. Didn't end up doing that well for me, but I like the business today. I still own shares, and
it's recovered in the last week. It's done really well.
Well, they're an interest rate beneficiary.
True.
Yeah.
Everything's interest rates at the end of the day, at least in the short run.
Yes.
That was a fun episode. Wise and Remitly. I own Remitly. I think you own both. Two companies that just put them on the watch list, at least. Fascinating companies, and have just really grown. They're doing quite well. Anything else, Ryan? Or
no, no, that's about it. It was, it was not on my bingo card for 2024. Enron coin, Huck to a coin.
The bubble's
Palantir
back.
hitting $200 billion in market cap. Yeah, it just goes to show how many surprises can happen in a year. So unpredictable.
Yep. Any closing thoughts for the listeners as we head into 2025? Anything you want them to know about the show, about any, maybe I'll try to come up with something too.
We're always looking to create new content, improve what we offer to listeners. We don't want to get stagnant, don't want to get stale with our show structure. So if you have any ideas, go ahead, reach out, let us know. We also love when listeners recommend stocks, and don't just say a ticker, but really kind of give us a little bit of a, 1 paragraph, 2 paragraph elevator pitch. Really helps. because it's the goal for this is to be a sounding board, a place where people can get equity research, hear investing discussions, and it helps if we hear back from audience members. So thank you all for listening throughout 2024, and here's to another good year of the podcast in 2025.
I agree with that sentiment. Maybe I will give some parting words regarding investing in the market cycles and Mr. Market. Do not let the bubble get to you. What I mean by that is don't let the FOMO, don't let the fear of missing out, don't let your idiot neighbor who has 500% returns on fart coin get to you, and stick to the strategy that you believe in, that you know works over the long term, the one that fits with you, and eventually it'll work out. It doesn't matter if anyone's getting richer quicker than you.
Very true. Yeah, that is a nice advice.
It's hard, and
on the flip side, don't become a perma bear.
Yeah, exactly. Yeah,
things in 20 years, you're gonna forget this ever happened. So long-term pessimism never works out.
Yeah, it's okay if someone is making money and they get 10x in some stupid meme coin. That's fine. It's fine. It doesn't let them do that. Let them do that as long as
we're just speaking to ourselves here.
Yeah, exactly. Well, that's why my advice. This was my advice and what I want people to remember, because it's something that I think everyone, and myself included, you have a hard time dealing with. The keeping up with the Joneses. My neighbor's getting rich. What's happening? Everyone has that instinctually. Just got to fight it a little bit.
Yeah. All right. I think that's going to do it. You want to take us out?
Yes, I can. Thank you to all the listeners. 2024. Hopefully you enjoyed this episode. We got some great stuff coming in 2025. More investor overviews, more stocks we're studying, more interviews with fun and insightful guests who can analyze stocks, sectors, all that good stuff. Let's hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or a recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, once again, and we'll see you in 2025.